Hi, I'm Vivek Kartha, and welcome to Deconstructed. Every episode, we're discussing the future of the world's largest asset class, real estate, through the eyes of the people who live and breathe it. Thank you for joining us, and let's get started. Today's episode is brought to you by Workspace. Workspace has built a better way to manage real estate without all the clicks. With a suite of modern, intuitive products for commercial real estate operators, Workspace reduces the friction between assets, data, and people, allowing CRE professionals to streamline all their daily operations across property management, asset management, and beyond. Learn more at www.goworkspace.com. Hi, everyone. We are here today with Jim Hancock, who is a Senior Vice President of Capital Markets at NAI Robert Lynn in the Dallas-Fort Worth area. Jim, thank you for joining us.
Good afternoon, Vivek. Thanks for having me.
I want to get right into it. I know you're based and you have deep roots in Texas and you're in the Dallas-Fort Worth area. Maybe give our listeners a little bit of a sense of what things look like on the ground now from a mobility, occupancy, just how does the city look and feel compared to 6 months ago, 12 months ago?
I would say that like a lot of the rest of the country, that 6 months ago, maybe not a whole lot different, but maybe a year ago when COVID started, we were just as scared as everybody else was. But I think that as time rolled by, a lot of companies learned how to deal with the pandemic and coming into the offices and into their offices and different schedules. And our company, we came back in within a couple of months on an alternating schedule, and eventually we're all back now. We're all mostly vaccinated, probably 90% vaccinated, and we're maskless. And we don't ask who's vaccinated, but we just assume that most people are vaccinated in the office, and we are back to business. And I think you could probably say that for most of the city is I won't call it back to 100% normal, but there seems to be an exuberance of people getting out, going to restaurants, doing things that they've not been able to do for 15 months. And it seems like everywhere I turn, every place is just as crowded as ever. And people just seem great to be alive and happy to be out again. So it's a very good feeling to be out. Not that this is all over.
Yeah, I'd love to go deeper on that, and I will get into the asset classes specifically in a few minutes. But how do you think about the current point in time for the Dallas-Fort Worth real estate market? And I know it's nuanced, and I know there's differences by asset classes, but is this a growing time? Is it contractionary? Is it up and down? And comparing it to your prior experiences and other recessions and other world events?
The current time we're in is not like any time I've ever seen. I've been in the business for 36 years, and this has just been incredible. Just the amount of growth that we've had. Maybe just a little bit of a slowdown during the peak of COVID, but overall, without getting specific about asset classes, which we'll do later, the things are just opening up. We still have tremendous job growth. We have tremendous population growth. We seem to have there's a lot of companies still moving to town. The city is we always talk about the main things that you put in the back of the operating memorandum about, the background of the wide Dallas-Fort Worth, et cetera. Just it's basically a simple time zone, good airport. We're in the middle of the country. You can get anywhere from here within a couple of days truck driving. We're probably 90% of the population. And it's a low-cost state. There's no income tax, although we do have some pretty high property taxes. Generally speaking, I won't call it the Wild West, but it's a can-do state with a good attitude.
Yeah, I think that explosive growth, and speaking about it's a time like you've never seen before, lines up with something I saw on the NAI Robert Lynn website, which is 2020 had 1,000 plus transactions. And I think for an outsider, they might hear that and think 2020. That was a terrible year for businesses all over the place. How is that possible? How is that possible?
I think 2020 was a record year for us by a pretty good amount. And I think probably for the most part, we had a lot of industrial transactions. A lot of it, we had 7 industrial leasing guys here that made over $1 million. And these are leasing guys, and the activity has just been astounding, mainly because of industrial. Maybe a little bit less robust on the office and retail side, but now as we speak, those parts of our business are picking up pretty marked pace as well.
Yeah, let's go into that. Let's just start with the industrial market as a whole. And for people that are less steeped in commercial real estate, what's going on with industrial? Why is it so hot right now?
Dallas is, I think, I forget, we're the 3rd or the 4th largest industrial market in the country. We have close to 1 billion square feet of industrial space that's on the ground. And that's because Dallas, like I was saying before, Dallas-Fort Worth is in the middle of the country. It's within a very close travel distance of a large segment of the U.S. population. The cost of doing business here is low. The lease rates are low, or lower than in a lot of parts of the country, although there's a lot of upward pressure now on lease rates and building prices. But the pandemic, obviously the demand in industrial real estate is really caused by a couple of things. One is just pure population growth and demand, and then the other part is a new way that we do business. And that's so that maybe a few years ago, maybe the retail sales were maybe 10% online, and now we're getting close to the mid-high 20% range. And so for there's a metric I think that the CBRE research folks came up with, that I forget how many $1 billion in retail sales there are, it creates 1.3 million square feet of industrial demand. We could Google that and look it up, and I'm sure somebody could look it up and see what, if we have a certain amount of growth in online sales, it creates just that much more demand in industrial space. So it's really not just the retail that's causing the demand, it's just the business services. Whenever you have rooftops, we have residential growth in the suburbs, you got to have service centers, you got to have the last mile distribution to provide services to those communities. So it's really growth to provide for our local population, as well as distribution center, almost inland port to distribute goods from other parts of the country. We have one of the largest inland ports here in the country. We have a couple of, they're called intermodal yards that have these containers come off ships in LA and Long Beach, and they get stuck on a train just immediately, and they get shipped all the way from LA to south of Dallas, and they clear customs there. And so that's where the freight comes in, and it gets distributed throughout the country from that point. And so, yes. As far as demand is going, I think the first quarter we absorbed about 10 million square feet of industrial space just in the first quarter. So we're on at the current pace where we might absorb 40 million square feet of space of net absorption. And the construction is just going crazy here. I think there's over 40 million square feet under construction. And every developer in the country that you can think of, there's people I've never even heard of before that are now in the Dallas market trying to look for sites. And the developable sites that you can build a warehouse on or a distribution center are just getting further and further away from the central core, and which is making the central core type property or the infill industrial very expensive. And the occupancy rates are extremely high. For us means a 95% occupancy. That's very high. So I've seen the vacancy rates in the teens in my career, and so I've never seen an occupancy rate this low.
Yeah, I'm curious.
Just tremendous demand out there.
Yeah, so I'm curious with that. Is it a good time to be a buyer or a seller of industrial with all that?
Well, for sure, it's a great time to be a seller. And we could be looking back a year from now and thinking, gosh, I wish I would have sold, or I wish I could have bought more, or I wish I could have sold more. I mean, we don't know, but I think right now it's definitely it's on the seller's advantage when they're selling a property, because their prices are just incredibly high. If you're a buyer, it's extremely competitive to get a hold of the deal. The cap rates are, at least by our standards, are extremely low. The core assets, the newly constructed or with great tenants, and they're trading in the cap rates below 4% in some cases, and then and some of the core assets, some of the non-core assets, mid 80s, multi-tenant infill industrial properties are trading in maybe the below 5% range. And that's in my career, I've seen the cap rates as high as 12% for something like that. So
is a way to think about that then that folks who have historically been deep in industrial, like your team, are not necessarily replacing their portfolio like for like with industrial, or is it more nuanced than that?
It's funny. A lot of people have what makes this business hard. It sounds wonderful if you're a broker, but the difficult part, what I do, I don't really concentrate on the portfolio type of business. I concentrate on usually the private equity or the smaller trades, say between $2 to $15 million. And those are generally private investors or maybe one-off deals, one-off being one building, one single building, maybe a couple in some cases. A lot of those sellers, there's a big resistance to even though they see the price just being crazy and wondering whether will ever stay this high, or they have a fear of reinvestment, or the fear of trying to find another property to replace it in a 1031 trade. So you might approach somebody and then they might fully agree with you. But sitting in when you tell them that the property is worth $110 a square foot and it's probably going to trade at a 5 cap, and they say, that's great, that's fantastic, I only paid $50 for it 2 years ago, but what am I going to buy? If I sell, I'm going to pay a capital gain tax. They want there's a big fear about what to do if they sell, which is sort of ironic. But I think everybody in real estate, even if you're selling houses, you wonder if you sell your house you live in California, you probably sell a house. Starter homes begin at $1 million. Where are you going to live if you sell your house? That's the question for those guys. As far as the institutional investors, they're buying and selling stuff all the time in different parts of the country. And so they just, for whatever reason, timing wise, they decide to take some chips off the table. What I see is more of on my side is more, direct emotional, and maybe one or two people making the decision instead of a, investment committee. Where there's maybe more some emotion involved on what am I going to do with this big gain that I got here? I don't want to pay the tax.
Yeah. I've heard that story from individual investors, from homeowners. It's a record time to sell, and then you turn around and you say, I got a bunch of money, I can't buy anything.
It's like, now it's great if you don't plan to buy anything. If you plan to go ahead and, let's just assume that nothing happens to the long-term capital gains tax, so it's maybe a great time to sell. If that's the case, and maybe the long-term capital gains tax will be as low as it's ever going to get. Maybe this is a great time to sell. So you could also take that argument. Some people I talk to have, and some people believe that whatever happens in Washington, it's going to be retroactive back to, I think, April or something like that. And they're worried about just taking a big hit for that as well. But really the overwhelming, if you have any objection to listing a property or putting it on the market or whatever, it's the overwhelming first objection to get to is, or to overcome is, what am I going to do? And so that's challenging because you got to have to think about things to sell them or trade into, or maybe even talk about going to a different market that has a higher cap rate. Maybe that's a strategy that some people do. There's a lot of people that are based here in the Dallas area that just given up buying stuff here locally, and they look at different markets across the country that do have higher cap rates. And these are some pretty large sized cities. Not a huge difference. Maybe it might be easier to buy in a different market, and maybe those markets are maybe at a different point in their development. Maybe we're near the end of a cycle, and the other markets are early in a cycle. It's hard to say. It's really hard to say.
I understand all that. I'd be curious to take the other side of that. I know another asset class the team invests in is retail. So you talked about the tailwinds pushing industrial, the changing way we do business, the changing way consumers buy and transact. And that's all great for industrial. And now take the other side of that chasm and let's look at retail. And we're seeing those tailwinds become headwinds in some ways. Certainly the pandemic was one, but also the acceleration of this change in the way we do business. How are you thinking about retail? Is that opportunistic or is it similarly a time to freeze investing?
I think it's an opportunistic time for retail investment because for so long retailers couldn't do anything. The restaurants weren't open. Some stores would only allow certain number of people in at a time. And now I think there's this awakening going on. And I think that certainly retail is in a different position than industrial is in on its cycle, because here we are, people are just getting a fresh restart. Maybe retail tenants are taking advantage of maybe restaurants that have maybe gone dark and stepping into a space that's already partially finished out that they can use. And so the startup is, of course, I'm not a retail expert, so I couldn't tell you exactly what's going on, but I know our retail guys probably didn't do nearly the amount of business they would like to have done last year. And I think they're really starting to come alive so far in the last few months, just because of the pickup of activity and people just getting back to business. And retailers, they've been going through this change a long time. They've been going through the issue about online sales before the pandemic. Huge surprise. It got hugely accelerated during the pandemic, but they were already having to do business differently before this all happened. So I think the retail type uses that you're going to see do well are going to be the restaurants, the things the experiential type retail places that people want to walk in the store and they want to look and touch and feel, and you just can't do very well online. Or maybe it's a hybrid type of approach that some retailers have a lot of their business online, but there's also a part that maybe a smaller bit than they would have had in the past for people just to come actually see the product in person.
Yeah,
kind of a smaller version of the big boxes are, we'll say, dying, but they're just the big box stores were probably the worst, felt the worst of the pandemic and the transition to online sales.
Switching gears a little bit for this last segment, I'm amazed at your experience. You said 36 years. You've touched so many different areas of the real estate ecosystem: leasing, property management, repping tenants and owners, now capital markets, transactions. What advice would you give to younger people entering the industry in terms of building a successful career in real estate, what you've learned, and specifically what you think the industry could use more of?
I think some things will never change. And I think technology might make parts of our job easier. When I got in the business, it was a luxury to have a fax machine. And now everything is just things like DocuSign, or just, for me, when documents have to get signed by multiple parties so frequently, things like that make our job easier. That's going to continue to change and evolve over time. But one thing that I would tell younger people getting in is never lose sight of how important it is to be face to face with people, to meet people, just to get to know them, to form a relationship and understand them and understand what they like, what they don't like, and be kind, be nice, be fair. That's never going to go away. You can't replace that with a machine or technology. You just have to have the skill to be able to form relationships. And let's face it, any kind of sales is people will go out of their way to do business with the people they like. And that's going to be no exception down the road, no matter how much this business changes. So I would just tell them to focus on being good folks and understanding how to form a relationship.
Yeah, that's great advice, Jim. Thank you for your time and look forward to speaking again soon.
Okay, Vivek, happy to do it. I sure appreciate the opportunity. Thanks a lot.
That's it for today. Thank you for listening. We'll be back soon, so please subscribe to Deconstructed on Spotify or wherever you listen to your podcasts. More details can be found at www.goworkspace.com/podcast. Today's episode is brought to you by Workspace. Workspace has built a better way to manage real estate without all the clicks. With a suite of modern, intuitive products for commercial real estate operators, Workspace reduces the friction between assets, data, and people, allowing CRE professionals to streamline all their daily operations across property management, asset management, and beyond. Learn more at www.goworkspace.com.